Many physicians want to be able to buy a home, sometimes in training, sometimes right afterward or a few years later. There are financial hurdles that prevent physicians from being able to get into a conventional mortgage, though. They might have a very low income because you're in training. Or another thing that underwriters look at when you go to apply for a mortgage is your debt-to-income ratio. With your student debt, that's a big problem on the conventional mortgage side. That is why the physician's loan program is fairly common amongst many lenders. This is an opportunity for you to be able to show, yes, I'm still in training, or yeah, I'm waiting for credentialing to come through, or yes, I know I have $400,000 in debt, but as an attending physician, I'm going to be making $200,000, $250,000, $300,000, $400,000, $500,000 in income. And lenders, they know that there are these unique facets of the physician career track. And so what they do is they adjust the typical requirements with regards to debt to income ratio, as well as down payment amount. And it's because they know that not only do you have a high income that is coming, they also know that you have very, very high job security. And so that makes you a lower risk in other ways. Lenders, therefore, are willing to make some concessions. So what is a physician loan? It is a way for you to buy a home for as little as 0% down. Sometimes lender will require you to put 5% down if you're borrowing more than $750,000. So it's not always 0% down. And that's another thing. It's not like you've got a lot saved. You've just been living on $36,000, $4,000 a month for many years, and you don't have 20% or maybe even 10% of a down payment lying around. This allows you to secure a mortgage without making any down payment. The other benefit is there is no private mortgage insurance. If you go through a conventional mortgage, you typically are required to either put down 20% of the purchase price as a down payment, or if you put down less, like 15, 10, or 5%, then the lender is going to charge you private mortgage insurance. This is a fee that they charge you that is meant to mitigate the risk of you being a lower equity borrower. Because if you put down 20%, you own a lot more of the home. Whereas if you put down less, the bank is assuming a greater risk. So they will charge a private mortgage interest fee for conventional loan borrowers who put less than 20% down. With a doctor's loan or a physician's loan, that PMI, private mortgage insurance, is not a factor. So those are the two main financial benefits of the physician's loan. There are some things that you should consider and be careful of, though. The first is that just because there's no PMI being charged on a doctor's loan, it doesn't mean that the overall cost of borrowing through a physician's loan is cheaper than the conventional route. And the reason for this is because depending on the lender, sometimes the conventional mortgage rate program range is set a certain level and the physician's loan rate range is at a different level. And it's possible that the baseline interest rate of the physician's loan is higher than the conventional. So even though you're reducing your cost while your equity is below 20% by the private mortgage insurance cost, what is the actual interest expense that you are incurring through the physician's loan? You need to know and you need to compare. Here's an example. If a conventional loan is charging you a 7% interest rate and you're going to pay PMI on top of it, which in my experience tends to add around 0.4% to that interest rate. It's not that exactly, but just for the sake of this example, if you also compare to the physician's loan and the physician loan rate is 7.6%, then sure, the PMI is there and it's costing you more, but the net interest rate expense for you on the physician loan is higher. And that doesn't just end when you hit the equity point of 20%. That is for the life of the loan. So in this situation, the physician's loan would end up being more expensive for you. It doesn't mean that you shouldn't do the physician's loan though, because of the other benefit that we talked about, the 0% down. In the end, this just means that it might be costing you more to be able to access that 0% down mortgage. And if that fits in with your financial planning process, and you know that it dovetails well with your other expenses and your savings plan and anything else that you have going on, then it's fine. You just need to know the details. The second concern is related to how much of a house you're going to purchase. When you see that you can put down 0%, you think, wow, this is great. I could buy a house that's $400,000 or $700,000 and it would still be 0% down. That's really, really dangerous thinking, because you're borrowing $300,000 more in the second scenario. So there's definitely a big difference, and you want to make sure that you are evaluating the sustainability of you living in the location that you're buying, that you really know that you want to live there and that you want to work at that job, and financially speaking, that your income can reasonably support that mortgage. So if you have a household income where you've got 2 doctors, say you've got 1 hospitalist, 1 emergency medicine physician, and between the 2 of you are making like $650, you could reasonably afford a $700,000 home. Would you be able to afford a $2 million home? That would represent like 3 times your income. That's not to say that it's always a bad idea to do that. It's just that when you increase that ratio, what you're doing is you are intentionally placing greater pressure on your budget to pay for that housing cost. And that's why it's so important to consider everything else that you have to pay for. Student loan payments, cost of living, supporting family, sending money back home. If you came to this country to train and now you're living here, but you have family that you want to support back home. There's all sorts of things that have to be factored in. And you want to make sure that decision of the home fits in with what else you have to pay for. And remember, one other thing that you have to pay for is saving for your retirement and saving for other long-term goals that matter to you. Last item, closing costs. Even if you're putting 0% down, you're going to be paying for closing costs, which is going to range between 2 and 3% of the purchase price. That's going to include attorney fees, recording fees, prepaid taxes, prepaid insurance, the premium on your the premium on your title insurance. There's all sorts of things that go into it. And so even if you don't have to put any money down for the down payment, you still need to have quite a bit of cash saved up in order to pay for those costs, as well as the inevitable maintenance that will ensue with your new home. That's the physician's loan for you. There's lots of reasons to consider it. Just make sure that you're looking at all these details and doing a proper pros and cons analysis so that you make sure that you go about this the right way.